spend about 25 minutes talking, I hope, on a little bit more of a fundamental level about both the real purpose of an IPO and also the real opportunity that an IPO represents for a business that either is going through an IPO or has gone through an IPO. That purpose and that opportunity, I think, are things that, at least in our experience, not enough companies and management teams and even boards really hold in their heads. I don't think enough companies have a firm enough grasp on what the underlying purpose and the underlying opportunity really is. And one of the reasons for that is as we've seen today, there's an immense amount of complexity in this process. There's a heck of a lot to remember. And so even though look at that, even though there's a huge amount of resources and skills and intelligence that are deployed in the IPO process and in service of that process, I think just remembering the basics is pretty critical. So first thing is that, what is the process? What is the purpose and opportunity of the process? It's not about valuation. Valuation is it's a number, and it's a number at a point in time, and that number can change. So valuation is, of course, important. You want it to be higher rather than lower, but valuation is an outcome of what the IPO is focused on. It's not the most important thing about the process itself. The other thing I want to point out is that every company, every good company, spends a heck of a lot of time and resources on thinking about values, the values that govern the relationship between the product and the customer and the company. This is super important. Anybody who's a CMO in this room or has a CMO knows that this is basically what the brand is all about. But I want to call your attention to the fact that before the IPO, you have values and you have brands. After the IPO, you're going to have value and brands. And then before the IPO, you have a valuation. And after the IPO, you have a valuation. So what really is the essence of an IPO? It's about value. And so if you think about how we define an IPO, in a lot of cases, it's just about taking a private business with a few hundred, maybe under 100 shareholders to becoming a publicly owned company with maybe hundreds or thousands of shareholders. But if you really think about it more fundamentally, an IPO should be all about a process that is meant to standardize the way that companies talk about their value. So a basic goal of capital markets regulation is just get companies to talk more clearly about how they make money. Why do we do that? Well, if you look at the history of capital markets regulation, I don't want to spend too much time on this, but it's a history of boom and busts. If you know anything about the tulip fad back in the 1700s or 1600s, all the way through crypto now, the history of capital markets value is also the history of innovation, followed by confusion and speculation, followed by regulation, which is trying to get people to unconfuse the way value is created. So once again, what's an IPO? Before you go public, you should be spending all your time, and we've heard about this a little bit today, monetizing and marketing the product-customer relationship. If you're not doing that, you probably don't have a successful business. After the IPO, though, you should be marketing not just this, but marketing a value creation system and not just disclosing financial performance. So what does that look like? Valuations depend, as it turns out, as much on how you make money as on how much money you make. And it's very easy to get distracted by metrics and measurement and disclosures, and it's very easy to get distracted and focus on how much money you make or whether you're making enough money. But really what you have to focus on is conveying to people, all your stakeholders, but obviously especially investors, how you make money. So 2 key insights there. First is that value systems are not intuitive. The way that businesses really make money on a systematic basis over and over again, they might make more money, they might make less money at various times, but the system for making money, this is not all that intuitive. Even the disclosures are not that intuitive. A lot of people have trouble just reading balance sheets and understanding what is being reported. So you can imagine that the underlying system for what drives those numbers, not intuitive. Here's an example. So you have your business, which is the money you do or do not make, how you spend that money, what your balance sheet and your finances look like. That does not necessarily translate into how your business is understood and perceived. Specifically, do you have an advantaged consensus among your stakeholders, including your investors, about your business's ability to succeed? That does not necessarily equal your business. And also, your business does not necessarily equal an understanding about the value of your business, which really means the degree of optimism or pessimism about the success of your business in the future. Not just what you're reporting at a moment in time, but will it succeed in the future? So these things are often assumed to be co-equal or synonymous or the same thing, but in reality, they aren't necessarily. You got to work to make that the case. The second thing is that just like value systems are not intuitive for people, they're not intuitive for algorithms either. And why does that matter? Somebody earlier asked about, does sell side scrape, use AI to scrape things. But the other reality is, notwithstanding the mainstreaming of AI over the last 18 months for like the consumer marketplace, Wall Street has been using versions of AI for, almost 2 decades now. And most of equity markets trading is actually driven by some form of algorithm, by some measures 60 to 75%. So yes, there are humans who make decisions. There are portfolio managers. There are institutional investors. There are sell-side analysts. There are people. But in fact, the day-to-day decision-making about whether your stock gets sold or bought, whether you trade up or you trade down, in a lot of cases is driven by algorithms, which is essentially a form of AI, and they scrape everything. Earnings transcripts, CNBC interviews, press releases, shareholder letters. It all goes into the system. The algorithms do not read things the same way that people do. So if you aren't speaking to the machines in language that they understand, you can have a great investor narrative. You can have a great story that works for the people. But if you aren't also talking to the machines effectively, your stock will not actually perform well, and you will not be talking about your value, and you will not have your optimal valuation. It's a long way of saying relying just on quarterly regulated financial disclosures and traditional IR is kind of like marketing a product while focusing only on its features and not on its benefits. There's a variety of companies, a relative handful that do this really, really well. These companies up here, and there are, of course, some others as well, these are companies that are all as famous for how they make money as for what they sell. They understand a lot of these things. They practice them differently. They invest in IR in a different way. And so let's talk about what that looks like. I think, generally speaking, there are 4 key elements of IR. There's financial performance. There's market conditions. Are interest rates high? Are they low? Is your supply chain messed up? Is there a war on? There's sector and category acceptance, like, do you make electric vehicles? Are you a financial services company? And then there's what we call financial brand, which is, I guess, the belief, at least we call it, the belief your business will outperform in the future. Standard view of IR looks kind of like this. Very heavily focused here, and also a lot of anxiety and a lot of attention devoted to market conditions, less so down here. In our view, smart companies actually look at IR this way. Much more emphasis placed on the financial brand and the sector category acceptance. Specifically, up there, your regulated financial disclosures, P&L, balance sheet, leverage, guidance, market conditions. Here, going back, sector category acceptance, explaining how you perform relative to your peers with respect to your customers, defining your markets, and the intangibles. These are where you can exercise and create a lot of leverage in a good way. Because your required financials are table stakes. Everybody's got a report. And you either make money or you don't, and you have good results or you don't. Market conditions are out of your control. But how you compete and grow in your markets and why you win, this is where you can differentiate yourself, because really this is where you can talk about value, not just valuation and not just values. So a better approach is to Of course, do a great job on your S1. Of course, focus on your 10Q and your 10K. Everybody's got a report. It's got to be professionally done. Remember that this is out of your control, but really the big things are market your markets all the time. What is your market? Not just your products. And market your business model all the time. Don't just disclose your financials. Specifically, you can think about all of this as content. You've got required content. You have maybe some measured executive commentary about, let's say interest rates or whatever. But you must, if you're smart, spend a lot of time with trend and sector economic thought leadership, which means don't just accept third-party and competitor definitions. Don't just take sell-side analysts' definition of what your market really is and sit with it. If it doesn't advantage you, you got to educate them, and you got to push. If you do that, you reframe your business for yourself on your own terms. Similarly, tell stakeholders what your financial performance really means. You have to connect the dots to your insights and actions. Do not ever expect results to speak for themselves, because they just don't. So kind of what traditional IR overlooks, and some of the principles of what we call value marketing, is that, and somebody said it earlier, there's an enormous amount of information out there that's available to everybody all the time. Information isn't the key, explanation is the key, but it has to work for both people and algorithms. And most IR today is performed really only for humans, but a lot of that activity isn't done well. There are 4,000 public companies, an enormous number of them kind of trade below enterprise value. That is a failure of marketing. It is not necessarily a failure of performance. And most investing at this point is at least partially, if not wholly, governed by some form of AI or algorithm. So what you have to do is you have to balance and market value systems to both people and machines. So in terms of machines, I could spend a lot of time on it, but basically you have to be able to read, write, and score like an AI. So effective value marketing doesn't just tell better stories to influential humans, it also mediates machine analysis of your performance. You have to understand how the machines actually read, write, and score everything that you do. So key takeaways, which, by the way, I must say, we put up a bunch of iconic logos earlier, but every good company, honestly, can turn its financial information into a competitive advantage, done the right way. So there's a few kind of key principles here. First, you got to treat your business model as a product. Just like whatever the heck it is that you sell, your business model should be treated as a product. It should get the same investment, it should get the same time, and it should use the same resources and tools and techniques that you would to kind of market or sell the thing that you think is your product. Earnings, for us, that's business model as a minimum viable product. Like you can certainly talk about your financial performance every 90 days, but for us, for our perspective, you should really be constantly tweaking and improving that so that you're not just going out there with the minimum viable product. You should measure whether or not you are seen as an effective operator, and you should make sure your content is optimized for both humans and machines. So on this one, what does this really tactically mean? Is it build and promote content and messaging about your market, not just your product. So corporate PR, I mean, we've heard it a lot today, but it should work hand in glove with IR and marketing, but specifically, corporate PR should mine IR and FP&A for really compelling, relevant sector content. And that content should be programmed and syndicated across all digital and social channels. It should be easy to understand a business model from reading a portion of your tweets on X, for instance. Another way, earnings business model only is minimum viable product. We believe that you should invest in intra-quarter marketing. Start a financial blog. Start a weekly newsletter that's aimed specifically at investors and that is something that can be discovered online and scraped by algorithms so that you can talk directly to the shareholders on your own terms in your own way. And if you have disclosed your earnings, 6 weeks ago, that's all fair game. It's public information. You should continue to refer back to it. I think, Brian, you talked about this. If you made a prediction or had a result, and then something happens out there in the world 6 weeks later that confirms that you were right, remind everybody of that. You should talk about your earnings, your prior earnings, arguably every single week until the next earnings, and then refresh it all. Measuring whether or not you're seen as an effective operator, you can track and improve the degree to which analysts, financial media, and shareholders actually focus on your business versus your products and services. We find that most companies, if you go and you look at the sum total of public information about them, it is heavily, heavily biased towards the product. That makes sense, right? You sell the product. That's part of how you make money. But honestly, the better ratio is, especially for a public company that is comfortable being a public company, a better ratio is like 50-50. 50% of the commentary talks about how people make money or the company makes money, and the other 50% is about the product and the customer. That's a healthier ratio. Those companies with that ratio tend to have much more resilient valuations. And so they might have a bad quarter, they might have a good quarter, but their stock will go down less in a bad quarter. Their stock will go up more in a good quarter. And make sure your content is optimized for both humans and AI. I mean, to catch a thief, basically, you need to use AI or some kind of tool like it in order to understand how the algorithms actually interpret your results, because it's not intuitive and it's not the same. So all in, the whole idea is that you're creating a financial brand that is as powerful as your customer brand. And that's it. Questions?
The last part about AI and humans.
Yeah.
Like, can you actually get pretty specific about what tools are you saying that we should use to optimize this? Like, you have that 3 pictures with the green thing.
Yes, so that was a picture of our proprietary software. But the other reality is that, there are a number of tools out there that are open source, and you can even use those. You have to tinker with them a little bit, but we use a combination of stuff that we developed as well as applications of the open source ones. So at this point, we're sort of using 3 different tools. All of them, scrape data sets in different ways, and all of them, sometimes we even use ChatGPT, because what's nice about that is once you've got a data set, you can use ChatGPT to interrogate the data set in real time, just using natural language. It's not like having to use a database where you get very technical output and very technical input. So the screenshots were the stuff that we built, but we also do use two other programs too. There's a bunch of different ways to use it, but one of the ones we refer to in situations like this, because it's simple to understand, is you can create a lexicon, like basically a dictionary for every business, where if you analyze the public profile the way that the Wall Street algorithms, hedge fund algorithms tend to, then what you can create is a list of terms that tend to correlate positively, and they correlate well with hold the stock or buy more of the stock versus sell. And you can have a list of terms that correlate negatively. And you also see things like that are syntactical, like, for instance, trading algorithms hate complex sentences. So if you say something like, despite a supply chain problem this quarter, we feel like we managed our situation effectively. That's an okay sentence. It's plain English, but the trading algorithm will see despite, and they will see supply chain problem, and they will discount everything else. So in some respects, you could say just clear writing works for both machines and AI, but it's not quite that simple. And there are definitely ways of improving your score. I mean, like FactSet and Zacks that, for instance, that powers a lot of Yahoo Finance. Every company gets scored there, and you can even look up what the score is, or if you pay for FactSet, again, you will be rated as a business. You can drive your rating way up just by changing the way that your executives talk on an earnings conference call. Okay. Thanks, guys.